Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Cut to the Chase. Now, is a dollar equivalent to a euro? That's the key question increasingly facing investors after what was a big move in the euro-dollar currency pair overnight that saw the pair fall below a key level, bringing it one step closer to parity. Now, we last saw €1 equal to $1 all the way back in late 2002, which culminated a year that we'll now remember for its several high-profile corporate failures. Now, coming back to 2022 once again, what specifically occurred yesterday was the euro-dollar pair broke below a key technical support level of 1.0635 and touched a low of just above 1.05 before partly retracing the move. Now, several events were likely behind this move. The key one was further incremental escalation in tensions between Europe and Russia over Ukraine. Earlier this week, Russia had said it was cutting gas supplies to Bulgaria and Poland, arguing that these markets failed to adhere to the prior requirement to make payments in rubles. Now, while these individual markets have plans in place to source energy elsewhere, the concern in markets, of course, is whether this marks a significant escalation. Now, on a related point, the discussion within the euro area on potentially imposing some sort of new restrictions on Russian energy imports, including the possibility of an embargo, remained a live discussion. Media reports earlier this week noted that several proposals were under consideration, including the possibility of focusing on oil rather than gas or imposing some sort of tariff or price cap. Now, the economic impact on the euro area could be significant. The German government yesterday reduced its GDP growth forecast for this year to 2.2%, while also raising its inflation forecast to 6.1%. But Economy Minister Habeck specifically noted that this did not include any assumption of a Russian energy blockage or embargo, either of which he said had the potential to tip the economy into a recession. Now, recent economic data in the euro area was also weak. The German GfK Consumer Sentiment Index fell to a negative 26.5, which was significantly below consensus expectations and lower than the previous record low from May 2020 during the pandemic. A reading below zero here indicates expectations of a year-on-year cut in private consumption. Now, slow growth in China has not helped either, given China is a key export market for Europe. However, data showed that industrial production Q1 did jump 8.5%, which proved to be a silver lining amidst recent growth concerns. This data point, of course, did help domestic Chinese equities eke out a gain yesterday amid what was otherwise a weak day for Asian equities. Now, euro weakness does put the ECB in a somewhat difficult spot, given weak growth and inflation being still largely driven by energy prices, makes for a less compelling rate hike case compared to the Fed, for now at least. Now, markets are starting to price about 2 to 3 ECB rate hikes by year end, but one indicator of potential stress we would keep an eye on is the gap between German and Italian bond yields. Now, this has been widening as rate hike expectations have risen, but this could be one limit on how much the ECB can tighten or may otherwise invite specific programs to ensure that gap does not widen too far. Now, taking a purely technical lens, technicals argue the euro weakness could have a little further to go now that we've broken below a key technical support, with an increasingly overbought US dollar likely to constrain the move at some point. However, for the pair, a move into the 1.035 to 1.05 window now appears likely, with the next key support for euro dollar likely at 1.4049 and 1.034. Please do have a look at today's Daily FX Navigator publication, of course, if you'd like more details. So really keeping a sharp eye on the euro and European economic data, but of course China as well, given that's of course a key market. We'll take a pause there, but if you enjoyed this podcast, as always, please don't forget to rate and like it. Thanks for listening. Wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.